In this episode, I'm going to be sharing a discussion I had with Andre van Rooyen. He is the National Head of Sales for PayProp. PayProp are a third-party payment solution for rentals. Specifically, they look after real estate agents as clients and they empower them to be able to manage their rentals effectively. Why is PayProp pretty relevant? They manage 1.4 billion rands worth of rentals every single month. They're sitting with core data that empowers the industry to make better decisions, to advise clients correctly, and to share some insights into what's happening. This will be a discussion that we'll be having every quarter with every release of the PayProp quarterly report. Myself and Andre will be recapping that right here on the Property Corner. If you want to download that report directly and read it after this episode, check out the link in the description where we will add a direct link for the download. You can subscribe to the PayProp system too, where they will then send you that report quarterly as and when it is released. A last note from my side before we get into that discussion is this was the first one, so I apologize. We did have some issues with the quality, especially the visual quality. Audio was pretty good throughout the discussion, so we'll work on getting that better with every episode. But for now, I think there's some key takeouts and you'll enjoy the discussion. Welcome to the Property Corner with myself, Rowan Alexander. Yeah, we're live. So Andre, thanks. I mean, I've worked through this report that you guys have released. It's pretty interesting. I enjoy this sort of data because as a property practitioner myself, there's some very grassroots level things that we see. And very often we feel sort of, in a silo. We're not sure whether it's based on our business, based on the location in which we trade, our specific markets. But it's nice seeing data coming up, supporting some of the trends that we may have picked up on, and then also some things that we may have missed. You've in the discussion we had before the time, you highlighted some things that aren't in the report, but make for interesting discussion. So, welcome and thanks for being with us.
Aaron, thank you very much, and thank you for being able to share the forum with a passionate property practitioner. Yes, so just to get to the highlights of the PRI, we are very privileged, and it's these days it's all about data, decision making based on data, insights into the market, specifically with property practitioners, and a very competitive market. And in some of the markets where we see some great rental growth, it becomes more competitive. So, what do we do with the data? How do we use the data? And how do we, maybe build some business models based on it? So maybe just some highlights, happy to say, and some context is maybe needed here as well, but rental growth has outperformed inflation for the last 3 quarters. So last quarter, we saw 4.8% growth in rental nationally, compared to 3% inflation. So that's good news. I guess the context, and I think maybe something to consider, is what was the implications on utilities and taxes and so on. So what does it really cost to lease a property, and what does it really cost to rent a property? But from a rental perspective, happy to say that it's outperformed inflation. The next test, and this comes from maybe some challenging quarter, maybe a challenging half of 2023. It's good news to see a decline in our arrears. So how we manage our arrears is a simple percentage calculation. Have we seen a decline in arrears? And the answer is yes. And that's also happened for the last 3 quarters. So our arrears for the last quarter was 17.4%. That's on our entire processing book. And then we measure it as a function of the rent. So in other words, if your rent is 100%, by what percentage the tenants are in arrears with? And that's also gone down. So it started the year at around about 77.8% of the monthly rental amount. It's now ended the third quarter of 76.8%. So not only a decrease in arrears, but also in the amount of arrears decreasing as well. So those are the highlights. Some provinces outperforming others. The blue-eyed boys of the real estate industry in SA, the Western Cape's doing well, like they've been doing. A great place to practice, to be a property practitioner in. But again, there's a lot of competition. And then we've seen Limpopo also seeing some good growth. A bit of a dark horse, though, is KZN. KZN's only seen about 3% growth, but it's been increasing and there's been an increase in demand. Like I said, I think they're going through some infrastructure challenges at the moment, but I'm hoping they get it right because it seems like a lot of people is considering KZN as an opportunity to reside in. And then with regards to Limpopo, again, seeing some good growth with the rental, the average rental increasing. I, I, I think it's about 8.4%. There we go, 8.4%. And the average rental being 8,372. Just remember, our national average is 8,856. So some good news in the Limpopo, good news in the Western Cape, and maybe to look out for some opportunities in KZN if they get the infrastructure right.
On that, Andre, do you guys track any sort of semigration figures? Along with this rental growth, do you see any correlation? Is it something that you guys track? Interestingly, something like KZN or the Western Cape, you mentioned the fact that KZN may be considered as a home for many people. With that growth, how much of that would be attributed to semigration, or is that purely coming from a rental growth internally within the province?
So unfortunately, we don't track semigration, not yet. I would love to.
Okay.
I'd love to, and maybe as a curious point is how do we track that? I travel sometimes over the weekends, and I do tend to. I see the airports are filling up on Fridays and Saturday evenings, and traveling to KZN and Western Cape. So how do we track that? It'll be some great data. Unfortunately, not now. We don't have access to that. But I guess then, a good indicator is the rental growth percentages, which to me just talk to demand.
Yeah, I mean, we see it in the Western Cape is very often when people are moving down from different parts of the country, one of the first things that they opt to do is to rent. In the Western Cape, it may be different because it may be due to affordability. There's usually quite a big price shock when people get off the plane at the airport in Cape Town, and they realize what they can get for their money in the Western Cape compared to some of the other provinces. It's very often a shock, and from an affordability perspective, sometimes that first barrier to the market is actually renting. And then deciding where you're going to be, where you're going to set up your family, where you're going to be at work, where your kids are going to go to school, all the usual aspects that come with choosing a home, and then opting to purchase at a later point in time once they maybe have a better understanding of the market. So I think semigration could potentially be relevant, especially in provinces like the Western Cape. It would be interesting, if there is that ability to track that over time and see whether these things, these growths are, how much of it is affected by semigration, as that would increase demand hugely in certain provinces, and then also some of these provinces that are declining, areas that are declining in the sales values. It has a dramatic effect where people are exiting certain provinces and certain areas where there's simply not enough demand to sustain property pricing, and it would be interesting to see that correlation. So hopefully you guys can track that or find some metric to track in future. That would be really interesting to see, I think.
No, absolutely. The way South Africans look at places to stay with primary residence has drastically changed over the last couple of years. COVID's taught us a lot a lot about remote working and our ability to work remotely. And we live in a beautiful country. Why would you rather work in Gauteng if you could work in KZN in the Western Cape? So it'll be very insightful. I think the lifestyle, especially in certain income categories, is becoming a bigger priority. We can see that because of simply the Limpopo, KZN, and Western Cape becoming our priority locations. So yes, I would be very interested in those insights. With regards to the prices, and I did look a little bit into the Limpopo market and the sales market, and we've seen an increase in the property values for the most of last year, drastic increase in the property prices. Again, to me, that's an indication of demand. And then, lo and behold, we also saw an increase in the rentals. I made the point earlier, and it's something that my colleague Michelle Dekkers just touched on in an article recently, is are we keeping an eye on new building plans being approved in SA? And maybe just to give you an indication, and we touched on this earlier, the first half of 2024, we only saw 15,000 new building plans being approved. First half of 2023, already it was 19,000. So are we getting new builds? Is that dealing with the demand? If not, are we going to keep on seeing an increase in the rentals? I don't know, but we sure want to find out. The more insights we have, the better our investment decision making can go.
Locally, we can only speak for the local market where we are heavily invested in new developments. What we've seen is that the cost, replacement cost of properties due to construction inflation has had a huge toll on development, becoming more expensive, but also land availability. You talk about building plans. That's the final phase of the development. Prior to going to market is that building plan approval. But the reality is, by the time something gets to building plan approval, it's been in planning for 5 years. Possibly even longer, going through the land use management or the rezoning applications, all of these things, complying with all the conditions, doing all of the studies. That's a result of 5 to 10 years worth of work often. And if you look at those figures decreasing, it would be interesting to see in the 5 years prior, what was the planning applications, not just building plans, but actually sort of rezoning, because in the Western Cape, for sure, that has been decreasing over the last 2 years because land has simply become less available. Land which is suitable for development has there's definitely less of that in supply. And then also, if new land is prospected and found where development could potentially happen, infrastructure challenges are coming about. Is there enough electricity, water, sewage connections, road infrastructure? And these things take time to develop. So if you look at the City of Cape Town's planning ordinances, you have a look at their district maps, you can get an indication of where development is moving to and where things are happening. The scary part is that there's less and less potential coming about. And that's going to have a huge impact on the supply over the next 5 years, because if we're at a period now where there's less property going into that development system, that means for the next 3-4 years, looking forward, there will be less opportunity for new developments. And I don't know if this decline in building plans is as a result of that. I don't think just yet, because I do think 5 years ago circumstances were different. But is it due to developer appetite? Are they sitting on land where they're saying, we're not quite convinced that the end product that we create now would be suitable to the market, that we would have sufficient buyers, that we can achieve a rate of sale? Are they maybe looking at the construction costing and saying, we don't want to take this risk right now. Let's wait for the construction costs to stabilize to a certain extent, where we can project, if we're entering into agreements now and we're having to deliver this product in 12 to 18 months, we want some form of more certainty about demand and construction costs. These are all factors that play into that building plan submission.
Yeah, you're absolutely right. There's definitely a lag on, when you get to building plans approval. And, to me, it's if we're talking about the future and making decisions from a developer's point of view, definitely something to consider. And what do we buy for? And what would our end user be able to afford? And it brings us back to the affordability question, which is becoming more relevant, and something that we also need to keep an eye on as a rental building a rental book or a managed rental book or rental property practitioners, is our affordability tests and what is happening. You mentioned earlier that there's been also a lag in recovering on credit scores. So access to finance, availability, able to qualify for finances is definitely playing a role. By the way, the banks are saying from a sales point of view, the sentiment is changing because declining interest rate sort of always has that impact in the market. They feel the sentiment is changing. When we speak to the property practitioners in the market, they're going, yes, we hear that, but we're not really seeing it just yet. And so, why isn't that happening as quick? Maybe it's the credit records. So talking to an appetite of a developer, do we have willing and able buyers? Will we have willing and able buyers? Will our buyers' appetite probably not go in owning property? Are they concerned about infrastructure challenges? Are they concerned, do they want the liabilities that come with being property owners? But that all of that will help. All of that sentiment will help, obviously, the rental market growing in the right areas as well. So the priority, I think, demand is there, and certainly in the areas that are seeing growth. Will I buy? Will I rent? Time will tell. But affordability to me is going to be the indicator. Debt to income ratio is still concerning, especially sort of. By the way, we don't even publicize this. Under 10,000 rand, we're looking at 50-50. Looking at 50% of the income being spent on debt, 50% of the income being spent on rent.
Is that debt to income ratio done on a gross income basis?
That is done on a net income basis.
Okay, net income. So that's after tax. So I mean, below 10,000 rand after tax, 50%. I can see, and that even the 10 to 20,000 rand, 20 to 30,000 rand. It's high figures. That tenants are sitting on debt, and you need to consider this is tenants. This is excluding a mortgage repayment. If you take the average family in that price bracket and you add the debt of a mortgage repayment, that's not classified as debt at the moment. If that gets added to this factor, you're probably sitting at 65 to 75% in that average household, if not more, on debt repayment.
And luckily we are in an interest rate down cycle. And so the sentiment in the market is changing, and it becomes more accommodating and more affordable. I hope the market doesn't go and make more debt, though. If what we should be doing is prioritizing disposable income and maybe savings. And I don't want to go into that, but that is a very harsh reality for us in our market. If you consider average rents around 8,000, just under 9,000 rand, our traditional affordability tests would be 1/3 of your gross income, or of your gross income or net income. Is that a fair way to do affordability assessments? If that the debt to income ratio in South Africa is the case where it is. So from an investor's point of view and from a risk appetite's point of view, if I'm catering for the norm or sort of the average in SA, I have to be very careful about what the interest rates do, because it's going to have an impact on my vacancy. It's going to have an impact on my repayments, or my rental payments. So we often lose that out of sight, and I think, especially from property practitioners' point of view, we have to be more careful in understanding affordability when it comes to rentals, and that rolls down to affordability for sales as well.
Yeah, 100%. We see exactly the same. In the price brackets below 1.8 million rand, where joint income needs to be 50 to 60,000 rand, or even less, probably 50,000 downwards is where we're seeing the most pressure. And we had this discussion beforehand. The markets above that will often complain, and but they'll make adjustments and they'll continue. They'll still be in the market. They'll make some lifestyle adjustments, make some sacrifices, but they will continue to survive. Very often, the market below that's purchasing for 1.5 million rand, 500 to 800,000 rand. Those markets are, if you look at their debt to income factors, you'll find that they very often have no way to go if interest rates do cycle upwards. And even though they have immediate relief right now, with interest rates in the downward cycle, the concern is the remnants of the credit activity over the last 18 to 24 months. Have they fallen in arrears with other credits rather than just rentals? I mean, you're seeing those rental figures that you spoke about earlier. What are their clothing accounts looking like? Telephone accounts, municipal bills, vehicles. That's probably where most of that concern comes about. The good news, though, is that the markets above the average is probably where you want to be finding yourself right now as an investor, because and it's the sales market mimics this 100%. If you start looking at the north of 2 million rand, we're trading at, and our business level, we're trading at some of the highest levels from units and values that we have ever in our history. And that's reflected in your rental statistics too. If you look at the income groups north of 50,000 rand, those figures become exponentially better. You know, to the point where if you're sitting on a rental property now in the Western Cape, in our areas in which we trade, we've actually sort of determined a little simple factor, which is that our rental is the equivalent of 2/3 of a mortgage installment. So if your mortgage installment on the property would be 15,000 Rand a month, we expecting 10,000 Rand rental income. So if you take that into account, the moment you start moving to a 2 to 3 million Rand investment property, if you're able to afford that, you know, you should be seeing anywhere between 14 to 20, 21, 22, even up to, in some instances, the 4 million Rand bracket, where we're seeing 30,000 Rand in rental income. Those markets are very strong. I mean, we've got a couple of projects in those price brackets, and the rental demand as well as sales demand over the last 12 months has really astounded us. And it's interesting to see this data now supporting that. You know, you look at those debt to income levels in those areas, and you guys are reporting that they are decreasing.
Yeah, look, I mean, from an investment point of view, I mean, that's definitely where you want to be. I think the demand just seems to be increasing. There's been a bit of a dip in, like a 0.1% dip in the Western Cape for rental growth. But again, I think it's a function of supply and demand. That's definitely the market that you want to be in. I have to, however, get back to considering the other provinces as well, you know, the national average. You know, there's still a demand. The affordable housing market is a harsh reality, or the reality of the affordable housing market is very evident. And how do we cater as an industry for that? You know, how do we evaluate risk? How do we better understand it? How do we better understand our offerings? And you know, there's a lot of work needs to be done. Maybe it's consumer education that's going to help. Again, just talking to from a property practitioner's point of view, I often say this, and I often run these numbers by a couple of property practitioners who operate in those areas. And I say, my point is, don't not take the mandate. Do the managed rental, but understand the risk. Mitigate the risk. Try and mitigate the risk. Does this justify more often, you know, an inspection? Do I maybe have to do another credit check halfway through the lease agreement? There are some events, and by the way, COVID taught us this. Some good learnings from COVID was some people started defaulting on the 12-month lease agreements in the middle of the 12 months. Well, COVID happened, and what do I do to mitigate my risk? Does my lease agreement provide for an extra affordability test if an event happens like a default? Mr. Tenant, you default on your rent. Can we do an affordability test? I need to understand what's going on. I need to understand the context. So we have to understand the risk and manage it a little better. Definitely with regards to the more affordable brackets of our demographic.
And I suppose, Andre, the best way to be mitigating this risk is, you know, I suppose as a practitioner, is being strict on your deposits. You know, when households had less disposable income leading up to where we are now, very often you'd find property practitioners advising landlords to ease the deposit requirements. You know, if you're going into this period where household income is recovering slightly, and you know, you want to hedge yourself against these risks, the best way to do that would be to hold your deposits. You know, be strict on those deposit requirements of you know, that are normal in your market, and you know, hedge yourself in that way.
Yeah, look, there are a couple of ways. There's a couple of ways to go about this, and just as a preamble to this discussion, it's going to be important to keep an eye on the Rental Housing Act. There's been some suggested amendments. Not sure when it'll be public, but there's been some conversations regarding exactly this. What is the maximum amount of deposit that a landlord can hold, for example? And the sort of indication that we get, the rumors in the hallways are that there's going to be a stricter affordability test. They're talking about a stricter affordability test. Now, with regards to deposits, the ideas, and I call it ideas because this has not been promulgated, it's not public information, but the discussions are around maximum of 2 months rent for a deposit. Our average around about 1.3. So in other words, 130% of the rent on our platform. And in different areas, there's a different strategy to mitigate the risk. And one of that is holding a higher deposit. But remember, we think it's going to be capped at a maximum of 2 months. So that is one thing, one element. The other one is, again, the affordability test and conducting the pre-tenant screening. That's becoming a very big part of understanding the tenant risk. I'm not sure that landlords who manage their own properties always appreciate this and always have the tools to do this. The rental tribunal discussions are going to go around, Mr. Landlord, did you do an affordability test on this person? If there's some challenges with payments, did you consider his ability to pay? That's an affordability test. With regards to the deposits, often isn't enough. And now I go back to the higher end markets. I know the people in the Atlantic Seaport going, Andre, I'm asking 2 months deposit, but I've got a 400,000, 700,000 rand kitchen that's destroyed. It's not going to be enough. How do I still keep on mitigating this risk? Now, there are things like ad hoc inspections that you can negotiate. That's one way of going about it. Depends on your mandate. Can I justify going and have a look at, as a property practitioner, going and have a look at the property more often? Like you said, holding a higher deposit. And to me, the trick here is going to be to value and understand your tenants' risk better initially. Make good deals, sign good contracts first, and then hopefully mitigate that. We're getting better at this. We're getting better at understanding and our ability to signing good contracts first.
Good. I think that's some good advice, to people that are, to landlords. I think that's solid advice. It's like preparing yourself. We always say when you make good property investments from a sales perspective, it's when you buy right. And it's very much rings true in that same way. If you place right, in your tenant market, in your tenanted market, you do that homework properly. You place the right tenants. That's a large part of removing some of that risk. Something that you touched on, Andre, that I think is worth discussing is the national arrears recovery. And you've published a chart from Q1 2021 basically to date, and it's been a slow and steady decline of arrears. Now that speaks to more disposable income, which you guys are also reporting. But also there was a note which said that this arrears figure is approaching one of the lowest levels that it's been in the history of your index. Is that correct? Am I making the correct assumption there?
That's right. So we're happy to see this. This is definitely a highlight in the PRI, is the arrears dropping off. I think it's a function of management, arrears management being more effective. I also think it's also indicative of property practitioners being able to place better tenants. Obviously, the affordability and less stress on the expenses of our tenants also plays a role. But this is good news for investors. I think at least sort of maybe towards 2022. Investor appetite's probably not been where it should be. I think investors were concerned about infrastructure. They were concerned about repayments. They were concerned about how we manage it. But our data shows that we're getting better at it. It's probably because of lower interest rates. But remember, we work with property practitioners. A property practitioners who place a good tenant and also manages their arrears is worth their weight in gold. And that's probably why we're seeing some this arrears declining.
Then looking at some of the economic tailwind that has picked up in the third quarter and maybe how that would carry on into 2025, what is your PayProp take on this? Are you also excited about what's happening? It sounds like it, and what do you see these effects of these tailwinds? What have you identified as tailwinds, and how do you see this pushing on to the 2025 market?
Yes. So first of all, there's mixed sentiment in the market, or different numbers in the market. The banks seem to think that there's around about 10 million households renting in SA. Stats SA is leaning towards 19 million. The bottom line, it's a huge amount, tenants currently renting or people currently occupying properties who are tenants. We don't believe necessarily all of them will be in our market. In other words, mandates that our clients can pursue. We think that number is closer to about a million mandates that's still out there in the market for property practitioners to pursue. Landlords who need help, and I say this with the words with most respect, landlords that have to go and find property practitioners that know these numbers, that offer a value to them, understand the market, places good tenants, and understand their value. And we've seen property practitioners prioritizing managed rental books because it works well in an estate agency environment. It offers an annuity income. It's good business. It outperforms inflation, we just saw as well. So we're thinking, well, at least from a estate agency point of view, our thinking is more estate agents are going to try and pursue more of these mandates, more and contribute and add more value to landlords and growing their books. And with that, more landlords, the appetite for landlords are going to increase because they now have assistants. They now have people who can look after their arrears, that are successful in placing good tenants. So the investment vehicle or the portfolio, property investment portfolio appetite or investors' appetite should increase. By the way, the bank's offering some brilliant buy-to-let campaigns as well. They now consider rental income as part of your affordability test for buy-to-let properties. So all of these things, a lower interest rate combining, I think it's going to be good for the rental market. It's going to be good for the managed rental market. I'm careful for the property investor. We don't have that data, but it seems that if you're in the right area, the return on investments are good. I guess the other side of the coin is finding the right property. That's just always going to be the case to invest in. So we are quite bullish about the managed rental market for estate agents and managed rental books. It seems promising. Let's hope the infrastructure holds up. Let's hope the interest rate downward cycle keeps on. And then, let's be careful with the affordability test. If we can tick those boxes well, it should be a good business to be in.
Yeah, and Andre, I think you're touching on that sort of finding the right property, finding the right market segment, and you guys have a very detailed breakdown of regions. You give some good numbers on there. I can only speak from a Western Cape market. And one thing that does excite me is what we spoke about earlier, maybe prior to the recording, was this fact that post 2021, we were in a period where a lot of tenants opted to buy. And these tenants were maybe renting, as an example, for 15,000 Rand a month. They were possibly comfortable paying 17,000 Rand a month, but the mortgage installment for the home that they really wanted was 18 or 19. As the interest rate cycled downwards and the monthly installments came to within their affordability, the banks were willing to lend them that money. And they took that money, they purchased the property, and that created pretty high levels of vacancy. Where over the last 3-year period, we've seen landlords managing that risk and saying, you know what, let's keep our rental figures under control. Let's sort of pass minimal escalations through to our tenants, and let's protect their ability to be able to stay in the property. Let's make it more attractive. Now that pendulum has swung. We've entered into a higher interest rate cycle. The vacancies have dried up. It's become less easy to purchase property as a first-time buyer, and very often even on the second-time buy, where we're seeing more people opting to rent, and vacancies have effectively dried up. We looked at one of our clients. We had a discussion a while back where we said if they've got a very large portfolio, and if we were to cancel all of those lease agreements and re-sign them today, the leases would be 17%. The rental income would be 17% higher on average. They've taken the decision to say, well, the minimum escalation that they will take for the 2024-25 period is 10%. If a tenant's not willing to go up to 10% escalation, they going to end the lease and spend some money, repaint the property, and put it in the market for the higher value. Now, that sort of sentiment is from a singular client, but we're picking it up in a number of different spaces. It seems to be something that we're expecting in 2025, especially locally, a big jump in rental growth. So this from the scary part for the tenant is that they've come off the back of the best rental growth by province, but it's not because of it's not because it's on a low base. This is probably gonna increase even more into next year. That's not the best news for a tenant. However, the good news is that the affordability milestone is probably looking a little bit better. But from an investment perspective, the investor, the lower interest rate cycle, the affordability of your tenant, increasing, I think that puts you in a pretty good position as an investor if you are selecting the right properties. And that's where I agree 100% with you. I think if you're going to be investing in the right properties, you're probably going to be making some of your best investment decisions right now. Whereas if you do step into a pitfall and buy something in the wrong area and things do turn on you, you're probably going to be set up for a hiding.
No, absolutely. And, with rental escalations, again, it's something that I think we could do better with in our industry. It's always been a bit of a thumb suck. We now have the data, and if you're investing in Western Cape, the rental escalation conversation should be quite easy. Here it is. We've seen 10% escalation. There's a big demand. That's going to be my escalation based on solid data. And that's what we've been trying to achieve with this, is to empower landlords and to empower property practitioners to negotiate and to have these discussions in the market effectively. We have to maybe spend some time on Gauteng, don't we? Because the reality about what's happening in Gauteng, there is a little bit of an increase, and I'm not sure if this is the case in the Western Cape, but specifically with sectional title, the levies, increase in levies, and the lack of buyers' appetite in Gauteng has a massive impact. And that's sort of the other side of the sword, is we have a couple of sectional title owners in Gauteng holding onto properties, maybe not even 4 or 5 years old, in a sectional title complex hasn't been retained, special levies have been passed, and that's levy contribution is just it's a hard payment to make. And they're going, just stop the bleeding, put a tenant in here. Doesn't matter what. The tenant demand's not necessarily it's not close to where it is in Western Cape. So they're taking risks by placing tenants, high-risk tenants, to stop the bleeding. So that's the other side of the pendulum, is how do I hedge my exposure when it's going bad? And then when Western Cape market is, how do I make the most of it? Again, it should be data-driven, the decision. Affordability test to me is going to be, the crucial part of this going forward. But there's some good news. There's some good news.
Yeah, and thanks for what you guys do in terms of collating this data and presenting it, putting together these reports, because what you're saying is 100% true. The more data-driven decisions we can make, the more organic and natural our markets will be. Yeah, and that was something prior to 2024. During that 21 to 23 period, there were so many anomalies in the market. It was really hard to project and predict, where things would be, what sort of markets would be on the up and down swings, and to make investment decisions. And now, as data is becoming available and as the market normalizes again, yes, we're in high interest rate periods. Yes, we're in high cost of living periods. But you know what? It's a lot more organic, and it's a lot more predictable. And that gives me a level of comfort, because I'd rather be in the harder times, but have more certainty about organic growth and predictability in the property space than be in an environment where a lot of these things are anomalies, and the markets are hard to predict. So I'm thankful. If we've made it to here, I think we set up to be in a strong position. I'm very excited about the property market for the next 24 months, because I think the sentiment is that we've crossed that bridge of the high interest rate cycles. Yes, we've discussed pressures on household disposable income in certain segments, and accessibility to finance and things like that. But the banks adapt. The banks are adapting in the sales space, as you've mentioned, taking future rental into account, adjusting credit scores, or like scoring of applications. They've extended the ability to lend costs as well. So the banks react, and the banks are always in business, and they will always react to these markets. As long as the accessibility to finance is always there, we will be able to do business. And the trick is going to be, as you say, finding those gems in the affordability, placing good tenants, finding the right properties, and so thanks for what you guys do as a business to empower industry, to empower landlords, to empower agents, and for putting this data out. I'm excited, Andre, that we're going to be doing this. I think you guys have agreed we'll be doing this quarterly. Once you've released the report, we'll have that'll catch up in a discussion. So, Andre, this report is that we're discussing today is released quarterly. If people want to get access to this report, how do they go about doing it?
Yeah, good. So there's a link. Simply click on the link, follow the instructions, and we'll send you the report. You can even subscribe, and we'll send you regular insights as well.
Okay, so what we'll do on our side is we'll stick the link down below in the description. And if you're interested in viewing this report in its entirety, feel free to click the link, download the report, subscribe, and you will receive that on a quarterly basis. In our discussions that we have here, we will always post that link for you. Yeah, you'll be able to find it right here on the property corner. Also, thank you for your time. Thanks for joining us. I hope it's been useful to our listeners, but thank you for your time and your effort and for sharing this information with us.
It's a massive pleasure, and we hope we can bring more information to the market to give even more insights. I look forward to next opportunities, and yeah, let's make the best of the opportunities in the market right now.